Brent crude crossed $109 a barrel on Monday, the highest level in years, and the same day Shell announced the largest oil acquisition Canada has seen in a decade. That collision is not a coincidence. It is a direct readout of what energy majors now believe about the future of global supply. Shell's $22 billion deal to acquire ARC Resources is not an expansion story, it is a survival calculation. With Shell's reserve life index sitting below 10 years, the company had roughly 5.3 years of production left without a major new discovery. At current prices and production rates, that is not a viable position for a global energy major. The ARC acquisition immediately extends that runway by years, adding 374,000 barrels of oil equivalent per day, a production increase of roughly 14 to 15% overnight. The timing is driven by what is happening in the Strait of Hormuz. Iran's continued blockade has effectively removed 20% of global oil and gas flows from the market. IEA member nations have already released a record 400 million barrels from emergency reserves, including 172 million barrels from the U.S. Strategic Petroleum Reserve. Goldman Sachs estimates global inventories are draining at 11 to 12 million barrels per day, a pace that cannot continue past July without Brent remaining above $100 for the rest of the year. Under those conditions, long-life reserve assets in politically stable geographies become scarce. Canada, specifically the Montney Formation in British Columbia and Alberta, is now one of the most attractive such assets on the planet. ARC was not an obvious target. Its Attachie project had underperformed expectations, weakening its negotiating position. That weakness gave Shell an entry price, $32.80 per share, that analysts described as a discount in the underlying resource value. The deal also secures Shell's 40% stake in LNG Canada, the country's first operating liquefied natural gas export terminal in Kitimat, and positions Shell to participate in a planned second phase that would double capacity. After Qatar's Ras Laffan site lost roughly 17% of its LNG capacity in a recent attack, Canadian LNG has moved from regional infrastructure to a globally strategic asset with direct Pacific access. If the Hormuz standoff persists past July without normalization, Brent is likely to remain elevated through year-end, and M&A activity in the Montney will accelerate. Denver-based Oventiv's $3.8 billion acquisition of NuVista last November already signaled that direction. If a ceasefire is reached and flows normalized, some of the acquisition premium built into energy stocks will compress, but the structural argument for Canadian gas, long reserve life, stable jurisdiction, LNG export capacity, remains intact regardless of near-term price.
The same week, Shell doubled down on Canada as an energy destination. A Quebec furniture maker with 86 years of history announced it was shutting its doors. That contrast captures something real about the uneven distribution of the trade shock now running through the Canadian economy. South Shore Furniture, one of Canada's major ready-to-assemble furniture manufacturers, told its 126 employees Monday that production at its plants in St. Croix and Coaticook would wind down over the coming weeks. The company cited two compounding pressures: U.S. tariffs cutting off its export markets, and a surge of Asian furniture entering Canada at prices that violate WTO anti-dumping rules. Its own sales dropped 77% between 2022 and 2025. That is not a slowdown. It is a structural collapse of the market the company was built around. The causal mechanism here is less obvious than it appears. South Shore's products are not currently subject to any specific U.S. import tariff. The damage comes through a different path. American buyers at trade shows are now actively marketing their goods as tariff-free, which pushes Canadian suppliers into the same risk category as Chinese and Vietnamese exporters in buyers' minds, even when they are not subject to the same rules. Simultaneously, Asian manufacturers originally targeting the U.S. market have redirected shipments to Canada, where trade barriers are lower, flooding the domestic market with low-cost goods at dumped prices. This is the same dynamic pressuring Rogers Communications, though the sector and mechanism differ. Rogers cut its 2026 capital expenditure by 30%, roughly $1.2 billion, and is now offering voluntary buyout packages to approximately 10,000 of its 25,000 employees. The driver there is not a trade shock, but a combination of regulatory pressure, flat subscriber pricing, and $34.7 billion in long-term debt accumulated through the Shaw acquisition and a series of sports and media investments. Two distinct industries, two distinct causal paths, converging on the same outcome: headcount reduction and cost compression as the primary corporate response to margin erosion. Ottawa has launched a trade inquiry into imported cabinets, flooring, and storage furniture through the Canadian International Trade Tribunal, and the Canadian Wood Products Alliance is pushing for immediate provisional tariffs. If those tariffs are implemented before stockpiling accelerates further, they may slow the attrition of domestic producers. If the review drags into late 2026 without interim relief, more closures in Quebec's manufacturing corridor are probable. The benchmark to watch is whether the CITT issues a preliminary determination before midsummer. That date will determine whether remaining manufacturers can hold through the next production cycle.
Behind both stories, Shell's resource bet and South Shore's closure, runs a single macro thread that Canada's central bank must now navigate. Brent at 109 raises import costs and re-accelerates inflation. Canada's headline inflation already jumped to 2.4% in the most recent reading, reviving questions about whether the Bank of Canada can hold its current rate, rather than being forced to tighten. At the same time, the tariff-driven slowdown in manufacturing is exactly the kind of demand destruction that argues for easing, not tightening. The Bank of Canada is expected to hold its key rate at its April meeting, with Rabobank and Bay Street both flagging a hold as the central scenario. But the hold itself carries a conditional logic. If the Iran conflict extends the oil shock into summer, inflation pressure will build faster than the trade shock can drain demand, and a rate cut cycle becomes harder to justify. If a ceasefire materializes and oil retraces toward $85, the disinflation from lower energy costs could give the Bank of Canada cover to move. That $85 level, referenced explicitly by analysts tracking the post-Hormuz energy market, is the number that changes the BOC's options. The U.S. Federal Reserve faces a parallel version of the same bind, with Powell preparing for what may be his final meeting as chair. The Fed is expected to hold rates steady this week as well, with the FOMC weighing sticky services inflation against slowing growth data. Bond traders are watching both decisions for signals on the rate path into the second half of the year, and any language suggesting the hold is conditional on oil normalizing will move the Canadian dollar, which has been firming alongside crude. The weight of evidence through this week points toward continued holds at both central banks, with the conditional factor being whether oil can retrace without a formal ceasefire. That is a narrow path. If Brent stays above $100 into June, the inflation argument for a cut weakens considerably, and the TSX's energy rally will continue to mask the structural pain accumulating in manufacturing and telecom. The verification point is the Bank of Canada's rate statement language on Wednesday, specifically whether it upgrades its inflation and more cautious on growth. The market's current pricing of a mid-year cut will come under pressure, and the divergence between Canadian energy and Canadian industry will widen further.